Hey everyone. So the Fed cut rates again. And usually when the Fed cuts interest rates, it implies the economy is moving into some risky territory. But the new round of cuts are being labeled as insurance cuts, meaning that the Fed is trying to stay ahead of economic risks. So there's really an open debate on whether last week's rate cuts were even needed. Job growth is slowing, but it's still positive. So far this year, we've added over 1.2 million jobs. That's an average of about 158,000 per month. While this is a slower pace than what we saw last year, it's still enough to keep unemployment pegged at about 3.7%. As I've mentioned previously, there's about 1.2 million more jobs out there than there are people looking for work. And until that gap closes, the risk of a recession is still a ways off. That said, there's definitely forces raising economic risks. Slowing international economic momentum, the trade war, rising tariffs, moderating corporate investment, slowing manufacturing, and slowing home sales are all signals that the economic momentum is starting to taper. You know, it's a bit surprising that home sales have not gotten a boost from the lower interest rates. A steep drop in interest rates usually translates into rising home sales, but the housing market remains sluggish. Home prices are still up about 4.5% from last year, but sales activity is just 0.6% higher than last year. The pace of home sales have really flattened. This reflects continued homebuyer caution, but it also highlights changing behavior. Many millennials continue to favor the flexibility and lifestyle advantages of renting, which has kept apartment vacancy rates near 4%, the lowest we've seen in about 19 years. So there's continued economic risks like what's happening with the housing market and manufacturing, and that's driving interest rate volatility. Right now, we're seeing some very dramatic interest rate swings. The 10-year Treasury rate hit an all-time low of 1.45% in early September, but they rapidly escalated back up to the 1.8% range over the next 2 weeks. For investors, this reiterates the urgency of refinancing and locking in financing on properties that they purchase. Although rates could drop again, market volatility will likely remain in place until the trade issues with China are resolved. Recession risks do remain elevated. Although the 2-year, 10-year Treasury yield curve has uninverted, that does not mean recession risk has diminished altogether. The 3-month and 10-year Treasury rates are still inverted, so we could be looking at an economic softening or a mild recession within the next 18 months. Real estate investment remains a top option during periods of financial market turbulence, and the yields on real estate tend to outpace virtually all other investment types. While the yield spread over the cost of capital remains significant, somewhere in the 450 basis point range, it offers investors very strong positive leverage. But the two key questions investors should be asking themselves right now is whether they're maximizing their return on equity because properties have gone up in value so much over the last few years, and also whether they have hedged their risk across different markets and different types of commercial real estate. Those are the two things people should be focusing in on right now as they look at their portfolios and consider their options.